Investing in index funds is one of the best ways to passively build your wealth in the stock market. While it barely requires any work or skills needed, it's fair to say it's one of the simplest and safest long-term investment strategies for the majority of people. And for that, I think it's no surprise why Warren Buffett, one of the most iconic investors of all time, recommends most people should invest in index funds. So in this video, we're going to go step by step through the process of how to get started investing in index funds. So starting from the basics, we're going to discuss what is an index fund. An index fund is an investment that tracks the performance of a specific stock market index, with the goal to mirror or copy the returns of the market or a portion of it. And a stock market index is just a collection of stocks, bonds, and other investments that make up the entire stock market as a whole or particular industries or segments of the market. There are roughly 5,000 US indexes, with the three most being the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. The S&P 500, for example, is an index that tracks the performance of the leading 500 companies in the US. So if you own an index fund that tracks the S&P 500, that index fund buys the shares of all the companies listed in the S&P 500 index, which in turn, that index fund is going to copy, mimic the same movements of the gains and the losses as the S&P 500. So now you have an idea of what index funds are. Why should you invest in them? It's one of the most effective and easiest ways for investors to build wealth. You don't have to become an expert in the stock market to do it. There are a few advantages that come with index funds. First being broad market exposure. Since many index funds are diversified over many different sectors and industries, as well as they can include hundreds or thousands of stocks, bonds, or both as part of their holdings. Second is the broad diversification of index funds allows them to be lower risk investments. For example, if something happens to one, two, or a few companies in that index, you're less likely to be affected by the negative impacts as if you were to own the individual stocks themselves. When you buy an index fund like VT-SAX, which is Vanguard's total stock market index fund, that index fund holds 4,000 stocks spread out over 11 different sectors. So when you purchase a share of VT-SAX, you're instantly invested in 4,000 companies. Next is lower tax exposure. Index funds don't change their stock or bond holdings as often as actively managed funds. This often results in fewer taxable capital gains distributions from the fund, which could reduce your tax bill. Index funds hold investments until the index itself changes, which doesn't happen very often, so they have lower transaction costs. These lower costs can make a big difference in your returns, especially over the long term. Last is lower fees. Since the index fund mimics the underlying benchmark, there's no need for a team of research analysts to help fund managers pick the right stocks. Also, there's no active trading of stocks. All these factors lead to low managing costs of an index fund, which ultimately converts to lower costs for you. While these are great advantages to index funds, to be sure that you're maximizing your returns over the long term, what should you be looking out for when choosing index funds? The most important and probably easiest one to look over is expense ratio. This is a fee you're charged to cover the costs associated with the fund's administration, portfolio management, marketing, and other expenses. It's essentially a convenience fee for not having to choose, pick, or trade the stocks yourself. With that being said, you'd ideally want to pick funds with the lowest expense ratios. An example of a low expense ratio index fund is FXAIX. This is a Fidelity index fund that tracks the S&P 500. This fund has an expense ratio of 0.015%. To keep it simple, this tells you that with $1,000 invested, you'd be paying 15 cents per year in operating expenses. So you'll be paying 15 cents for every $1,000 that you have invested. The next one you want to look out for is tracking error. This is just the difference between the actual performance of the index fund and the benchmark that it follows or tracks. And it could be viewed as an indicator of how actively a fund is managed and its corresponding risk level. To give you a better understanding, if we take a look at the returns of FXAIX, which again seeks to follow the S&P 500 index, we can see that the returns are almost exactly the same. And this is good news because this is telling us the fund's being managed properly with a very small difference or small tracking error. And the last thing you want to pay attention to is minimum investment. So some, but not all index funds may require a minimum investment in order to get started investing in that fund. But once you meet this minimum investment amount, from there on out, you can add any dollar amount you want in the index fund and continue investing. Now, a majority of index funds are going to have a minimum investment requirement between $1,000 to $3,000, and this amount can make it a little bit discouraging when just starting out. Vanguard, for example, has some of the highest minimum investment amounts to get started with. Many of their index funds have minimums of $3,000, but don't worry, there are other brokerages that offer index funds that you can get started with that have no minimum investment at all. For example, Fidelity offers quite a variety of index funds with this $0 minimum. So even if you only have $100 to get started in investing, there's a Fidelity fund that you can purchase. Now that you have the basic concepts of index funds down, what are the best index funds to buy? There are many different investment strategies, but I'll be going over 2 different examples that would suit different people's goals. And then I'll show you some of the best index funds to invest in based on these different approaches. So the first is the 3-fund portfolio. This is an investing strategy where you have a portfolio that contains, 3 funds. These can be broken down into the following classes: a US stock index, international stock index, and a US bond index. This allows you to have your portfolio diversified in a simple and less confusing way, as well as you have your money in 3 different unrelated markets. Now, of course, based on your specific goals, risk tolerance, and age, you can decide how you prefer to set up the allocation of those funds. Here I'll be showing a list of some of what I believe are the best index funds based on each investing approach. With that being said, this is my personal opinion and not financial advice. So like I had mentioned before, the 3-fund portfolio should contain a US stock, international stock, and a bond index. And if you're looking for a simple way to be diversified well, this may be the way to go for you. Generally speaking, we're trying to figure out how much of what to buy is going to depend on your time horizon for retirement. The more time you have until retirement, then the more aggressive you can be with your portfolio. This means you can hold more stocks. And if retirement's close for you, then the less risk you should take, and you should have more bonds, giving you a much less aggressive portfolio. So if you're like me in your 20s or 30s, you can have a more aggressive 3-fund portfolio ranging in 70 to 90% in stocks and 30 to 10% in bonds. Having a 90-10 split would look something like this, with 70% in total US stock market, 20% in international stock market, and 10% in a bond index with any of the funds that I have listed. This strategy allows you to have a very broad exposure to not just the US stock market, but international and bonds as well. It removes any of the guessing work from investing, and it also gives you the best chance to recover from any market drops in the short term, since you know historically over the long term, it'll likely be going up in value. You could increase the aggressiveness of this method simply by removing one of the funds, which would make it a 2-fund portfolio. With this, you could follow the same concept and remove the bond index fund and allocate that 10% towards the international fund. This would give you 30% towards the international and 70% for the US stocks. This can increase the opportunity for more returns by not allocating that money to bonds. This is likely better for younger investors, but if you're younger and you feel more comfortable having some money in bonds because it fits your investing style better, then there's nothing wrong with that. The next approach is, if you're not looking to invest using the 3-fund method and you want something more geared towards growth, for that reason, you're willing to be as aggressive as possible with your portfolio and take on more risk. If this is your case, then these are some great index funds to invest in, and we have a variety of growth index funds along with some small and mid-cap funds offered by different brokerages. An example of a portfolio with this approach would look something like this. Around 30% of your portfolio being invested in a growth index fund, another 30% being invested in a total stock market index fund, 25% in mid-small caps, and the last 15% in an international index fund. Allocating your portfolio like so is shifting it towards more aggressive stocks by being invested in growth as well as both mid and small cap index funds. But you still have exposure from a broad market index fund along with the international markets as well. Now that you have an idea of some index funds that you may want to buy, let's jump over into how exactly to buy index funds. So when it comes to choosing a broker, it's important to remember that some index funds you can only buy if you have an account with that brokerage. And for the funds you are able to buy from other brokerages, you'll be charged a fee on each purchase. For example, if you wanted to invest in an index fund such as Vanguard's VT Sachs index fund, having a Vanguard brokerage account would be the best way to invest in this Vanguard index fund. The same idea applies with other index funds offered by other brokers. If we were to check out the fee to buy VT Sachs through your Fidelity brokerage account, you see they charge an insane $75 transaction fee, and that's for each time you buy it. I believe Vanguard is around $20 or so, but of course this fee can vary depending on each broker. This is all to say, if you want to buy Fidelity funds, just open up a Fidelity account. If you want Vanguard, open up an account with them, and any other funds, just stick with that broker that offers them. Now say you found the index funds you want to invest in. Let's get into how you can actually go about buying them. In this case, let's say you want to open a Fidelity brokerage account because you want to invest in a zero minimum Fidelity index fund. So once your account's opened up, on your portfolio page, you have this trade tab on the left. Once you click it, a trade window will pop up. From here, I'm going to click the drop-down menu and then select mutual funds. And don't forget, an index fund is nothing but a type of mutual fund. After switching, then we will click the drop-down for account and choose the account we want to buy this index fund in. In my case, I'm just going to choose the Roth IRA. And then for the symbol text box, this is where you'll type in the name of the index fund that you want to invest in. I'll use SKX as an example. And there you go. You see the current price? On the action drop down, I'll click and I want to buy this fund. And here in dollar amount, I'm entering the dollar amount that I would like to purchase. Then preview order. If everything looks good, then you can lock it in by clicking place order. It's official. You're now invested in an index fund. And if you don't already know, index funds are not like stocks where you can buy and sell at any time during the trading day. The orders are executed once a day, being after the market closes at 4 p.m. Eastern time. So if you buy or sell before that time, it'll take the price at the close of that day. And if it's after 4 p.m., it'll be the next business day's closing price. I hope this helps you with getting set up and invested with index funds for the first time. If you enjoyed the video, please leave a thumbs up. Be sure to subscribe if you want to see more videos like this as I post weekly. Thank you for watching. I really appreciate it, and I'll see you in the next one.